Well, traders and analysts seem to be very confused about where to look to for some direction. The market's swinging back and forth from positive to negative. What are you making of the markets right now?
Yeah, it's almost like we're back in that period in May where people aren't quite believing, and it's partly due to perhaps a couple of poor economic reads towards the end of last week, and perhaps those numbers coming from July and the first part of August are not exactly going to look great. But I'm still a firm believer that we are in recovery mode. It's much easier to come out of a recession because all you need is one positive quarter and you don't need two negative ones. But there are tentative signs out there, and I took solace in the words from Buffett yesterday, but more so from Marius Klopper's when those bulletin results were released, because he was starting to say, okay, well, China have wound down their stockpiles, but in the developed world, the likes of the US, Western Europe, Japan, he was starting to see increased demand. So that means whilst the developing world has been moving ahead quite strongly, the developed world, which accounts for half of the world's GDP plus some more, is starting to pick up slowly. So there are encouraging signs out there.
Are we seeing these tentative signs that growth is fast approaching? We're also getting different, as you said, economic perspectives at this stage. Some of the analysts I speak to saying we've been selling all the way up and now getting back into the market. Others say stay away, we're probably going to get another dip. How are you playing the markets right now?
Simply, we're longer term investors, so we look at what's available to us on a half a decade basis. So we tend to stick with the same stocks, and interestingly, we've been buying all along. So through the dips and through from September last year, where we really started getting pushed quite hard, we were buying at that stage because you never quite know when the recovery is going to come in stock prices. And we were wrong all the way through to March, but there were people who got in at that March level as new account holders, and they're showing enormous gains. So I guess it's a matter of trusting the asset class. We read about those interesting comments that Buffett made yesterday, would he be buying stocks over treasuries or cash? And I think he's right, because longer term equities do tend to outperform all asset classes. I think the one big thing that he has that many investors lack is patience, and that comes with today's fast-paced world in which people want super returns quickly. But investing is like buying a house. You don't buy it because you want to flip it next year. Well, that happened in the US a few years ago.
Warren Buffett wrote a piece in the New York Times. You alluded to that, and he was talking about the greenback effects and really obviously taking it from the greenhouse effect and talking about greenback emissions, and saying that eventually it's going to lead to inflation. This is why you shouldn't hold cash and you should head into equities right now. It's quite interesting to note that he is of the view that we are going to be heading into an inflationary environment, considering that the consumer is under pressure and the immediate problem right now is deflation. What do you make of those comments?
Again, that indicates to me what his timeframes are. The guys from PIMCO, I think a couple of days back, who ad nauseum referred to their new normal, were also indicating that they saw the dollar selling off. And I think it's more a move towards riskier asset classes, looking for something perhaps with a little bit more juice. But yes, all this monetary stimulus that has taken place across the globe has to have some sort of effect, unless the central bankers can put a brake on it at some time. But they don't want to put the brake on it at the risk of being able to crimp growth. I was fascinated by the commentary made from the Australian Central Bank, who seemed to be the first to come out of it and who seemed to be the first to perhaps raise rates by the end of the year. They said, well, hang on a second. Perhaps we're not going to do that quite yet because we're worried about choking off growth.
PIMCO is talking about a new normal.
They've been talking about it for about the last 9 months.
What is your new normal going to be? I mean, there's an expectation that earnings are going to recover in 2010. Others say we've set ourselves up for disappointment and we've priced in way too much.
Yeah, well, the world is in a new normal. Anyone who compares us to 1930 is completely nuts. There was no internet, no mobile telephony, and the only thing in common is the movements on a stock graph. So to be perfectly honest, also when people compare us to even a decade ago, I say, well, hang on a second, there are 800 million more people on the planet now than there were a decade ago. How can you possibly compare the two periods? So I think we've emerged into a tipping point and a shift in economic power. And that, I think in the West, people are struggling to get their head around. the influence of India, China on the world's economies, the influence of emerging markets such as Indonesia, Malaysia, Southeast Asia on the rest of the world, and Africa coming to the fore, countries like Nigeria, Angola being added to OPEC. I'm just fascinated with the moves that we're seeing in our lifetime, and I suppose some people in the Western world have a bit of a problem with it.
Truworths released results yesterday, a 15% jump in headline profits. A company that has been weathering the storm relatively well in comparison to the other clothing retailers. What do you make of this stock? Because it seems to be one of the favorites in portfolios.
That's interesting. It's got a high rating relative to their peers, and I'm talking just on a normalized price to earnings multiple ratio. So the market is telling you that they like their management team. And interesting, Michael Mark has been around on the board, I think this is his 21st year. So the guy knows the business pretty much backwards. But what are you buying when you buy Truworths? Are you buying someone who has a credit lending facility to buy well-marketed clothes? I think that is ultimately what it is. You've got to have a look at the investment and say, it's not a pure retailer. They run a book that's around 2.5 billion rands. Their credit sales to cash sales is 70 to 30%. So pretty much when you're buying them and you're starting to enter into a cycle where we've dipped off quite dramatically on rates, there could be potentially lots of upside. But I had a look at forward forecasts in terms of what analysts are expecting for next year. I think it's just shy of 4 rands a share. So I reckon at 37 bucks, they're pretty well priced. But should we see a turn, you'll probably see analysts ratchet up their expectations, and that's where there could be a little bit of upside.
Another company that's been weathering the storm, Capitec, and in comparison to its peers, it's quite interesting to note a bank that has been doing relatively well. Trading update yesterday saying headline earnings per share expected to be up between 35 and 55%. Why is this company also doing so well?
I think it's more about the market that you're servicing. And interesting, if you look back over a 5-year history with Truworths too, you see that they grew their number of accounts. They almost doubled in a period in the middle of this decade. And Capitec is much the same. It became too risky to service the low end of the market until everyone realized, well, hang on a second, African Bank and Capitec have been doing this for the better part of a decade and doing it really well. So I think whereas the other banks have been quite slow to get to that point, you've got to take your hat off to the likes of Able and Capitec for having banked that market. And I still think it's quite a high growth market, so very pleased.